Hello everyone and Happy New Year. Joe Follico for Insignia Futures and Options. In this video, I'll be explaining how to take advantage of falling stock and crude oil prices, so stay with me. Clients often ask me how to profit from falling prices, be it in crude oil, stock indices, gold, coffee, or corn. Some investors may not fully grasp the concept of going short, as most investors learned how to trade by buying stocks. Obviously, this means buyers could only profit when prices rise from their entry points. Unfortunately, this leaves long traders on the sidelines when prices are dropping. Why not try to take advantage of both rising and falling prices? As we've seen recently, stock indices and crude oil prices have been fluctuating up and down. Let's take a look at how to set up a trade to try to capture falling stock prices. As you can see in this E-mini S&P 500 daily chart, prices have been trending downwards overall for the last several months. Using the E-mini S&P 500 futures contract, traders could easily sell or go short if they feel prices will go down. This is where it could get confusing for some traders. They'll ask me, how could I sell something I don't own? I fully understand how this may not make sense to some traders, but when trading futures, it's just as easy to place a sell order to go short as it is to place a buy order to go long. You do not have to already own any related contracts to trade against or have special permission from your broker. If you think prices will drop, you simply create an order to sell the futures contract and that's it. For example, if you feel E-mini S&P 500 prices will continue to move down, you could sell a futures contract at the current market price, 3839.25 in this example. Looking at the daily chart again, we could see our first support level sitting at the 3805 price level. If you made this your profit target and prices did drop to 3805, you would have a gain of 34.25 points or $1,712.50 in gross profit. 1 point in the E-mini S&P 500 futures contract is worth $50. If prices were to drop to the next support level of 35.90, you would have a gain of 249.25 points or a gross profit of $12,462.50. Now, I'm not implying that prices will drop this low or even drop at all. Of course, prices can move up from your entry point, which would result in a loss. I'm simply illustrating that there are trade opportunities when prices are falling. You do not need to wait for prices to start rising again. Let's look at another example in crude oil. As you can see in this daily chart, prices have also been trending downward since mid-June of 2022. In this example, we'll take a look at a couple of futures options trade opportunities. Sticking with the short selling theme of this video, we could sell a futures option call above where the market is currently trading. With prices trading at the $77 to $81 per barrel price level, we'd want to choose a strike price above some major resistance on the price chart. I've identified a double top resistance level at 93.70 as indicated on this chart. I would recommend selling a call option above this resistance level. I see that I could sell a $95 call option for 50 points or $500 in premium collected. 1 point in crude oil equals $10. When selling an option, the premium or value of the option collected at the time it is sold will be the maximum profit available, less any trade commissions and fees. I chose an option that expires in 2.5 months. If crude oil prices stay below $95 per barrel until the option expires, the gross profit will be the $500 in premium collected. I hope you're finding this video informative. Please take a moment to click the like and subscribe buttons below if you'd like to see more videos like these. Another variation of going short when trading futures options is to buy a put option. A buyer of a put option will have the possibility of profit if prices continue to fall after the option has been purchased. When buying an option, the premium or value of the option is paid for by the trader when the position is established. Let's look at an example. If a trader felt prices would continue to move down to the next major support level of $70 per barrel, they could buy a $75 put option at a premium of 350 points or $3,500. One important point to remember when purchasing options is that you must cover the cost or premium before realizing a profit. In this example, we purchased a $75 put option for 350 points. This means that the break-even price level for the underlying futures contract has to be trading at $71.50 at or near expiration to cover the cost of the premium. To realize any gain, crude oil futures prices will need to be below $71.50 per barrel when the option expires. Of course, you do not have to wait for the option to expire to liquidate it. There are circumstances when an option can be profitable prior to expiration if there is a sharp move in the underlying futures price in your favor. Conversely, you can liquidate your position if the market is moving against you to cut your losses prior to expiration as well. I don't want to get beyond the scope of this video in explaining the mechanics of options trading. However, we have other options trading videos available that I will place links in the description below for those interested. In wrapping this up, I want to emphasize that you could take advantage of changing prices at any futures market, either to the upside or the downside. If you have any questions about these concepts, please leave them in the comments below or feel free to contact me directly. I'll be happy to help.